Tuesday, June 11th, 2019, Maneco 64, home of alternative economics and contrarian views. So this morning I want to look at a banker, a too big to fail banker, who said carnage in loan market can only get worse if the Fed cuts. And I also want to look at some comments that central bankers and others would rather want to forget that they made about the economy, about the markets, and policy in general. And of course, after that, I'll look at what the markets are doing this morning. It's just before 8 a.m. London time. So who is this banker? Well, it's Brian Moynihan, the chief executive of Bank of America Merrill Lynch. So in this article here from June 7th in the FT, it says, carnage in loan market can only get worse if the Fed cuts. A decade of ultra-loose monetary policy has caused an extraordinary lending boom. And I've spoken about these leveraged loans. I think it was late last year because The Economist magazine was starting to look into that. It's grown massively, these leveraged loans, over $1 trillion. Basically, instead of being bonds, corporate bonds, they're like direct loans from the big banks to companies who don't have a very good track record, who probably wouldn't be able even to issue junk bonds. So that's what it's all about. So what does the FT article say? So I'll read from it. The chorus of doomsayers warning of turmoil stemming from corporate borrowing added a powerful voice this week. And the reason why I'm talking about this is that we're seeing now the markets, investors, the Fed bankers, all saying that they're ready to cut again. We've had Bullard last week. We've had Jay Powell say that extraordinary or unconventional policy will become conventional, i.e. zero rates, even negative, more QE. And in spite of that, they're warning at the other side of their mouths that this could cause carnage. It's amazing. So it goes on to say, Brian Moynihan, the chief executive of Bank of America Merrill Lynch, warned on Tuesday that the growth of the leveraged loan market, where lowly rated and heavily indebted companies borrow money, could accelerate an economic downturn. He should know B of A has long been the largest arranger of such financing and then selling the debt onto investors. So yeah, they don't care because they just arrange it, they sell it on, they probably write derivatives on it as well, I'm sure. So this is what he said, I quote, "It'll be ugly for those companies if the economy slows down and they can't carry the debt and then restructure it. And then the usual carnage goes on." A bit like the subprime carnage, Mr. Moynihan, when all your friends and colleagues had to be bailed out by the taxpayer. You know, I mean, we're already getting signals that we're seeing a slowdown. We've got inverted yield curve from 1 month to 10 year, or more, like people look more at the 3 to 10 year. But anyway, the curve is inverted. We've had revisions down of GDP for the second quarter. Not the Atlanta Fed. The Atlanta Fed has second quarter GDP almost at 0. The New York Fed is cut it down to 1, I think. Even the Fed is cutting a revision of GDP. Jay Powell, goes on to say the article, Jay Powell, Federal Reserve Chairman, has made similar claims to Mr. Moynihan, saying that even if high levels of corporate debt do not cause the next financial crisis, they could exacerbate it. PIMCO, the giant asset manager, has also said it is pulling back from lending to U.S. companies. Lawmakers in the U.S. House of Representatives held a hearing this week on the topic, with academics also raising alarms. So, you see, Mr. Moynihan knows what's going to happen. Lower rates will push them even more into these leveraged loans. It's what the bankers do. But he's warning. that it's going to end in tears or carnage, as he says. The other thing I thought about yesterday, QT is going to end in September. That is the inverse of quantitative easing. They're going to end the sell-off of the Fed's balance sheet. It got up to about 4.4 trillion. Now it's just under 4 trillion. I think it's 3.9. Before the '08 crisis, it was around 800 billion. So much for watching paint dry. And what's that got to do with the Fed's balance sheet? Well, back in mid 2017, and I'm taking this from Seeking Alpha. It's an article by Neuberger Berman. It's from actually December 20th, 2018. It says FOMC like watching paint dry, ? Not anymore. So he goes on to say that back in 2017, Janet Yellen compared the Federal Reserve's steady policy normalization and balance sheet reduction to watching paint dry. So at the time I thought, oh, what a muppet, Janet Yellen saying it's going to be like watching paint dry. And we saw what happened, what's happened since, this FOMC meeting, which Mr. Berman is talking about in December of 2018. They raised rates by 25 basis points. And it even says here, 11 out of 17 board members expect 2 hikes or less next year. You see, this is this year. So they were expecting hikes this year as recently as the end of last year, December, which would bring the Fed funds rate well into the 2.5–3% zone of neutrality described by Powell previously. So they haven't hiked rates anymore. The market now is discounting 100% chance of the Fed cutting rates, I think before September, or at least at the end of the year. And they're going to stop their, normalization of the balance sheet, selling off assets, or the QT. And I'm sure Miss Yellen needs to get a new hobby other than watching paint dry. Maybe she should go out a little bit into the real world and see what's really happening in the real world, Janet Yellen. So what about quotes that people would rather forget they made? Well, one of the best ones, aside from the paint dry, I think Janet Yellen is going to be remembered for that, especially as the next crisis hits, paint dry. March 28th, 2007, and I quote, "The problems in the subprime market seems likely to be contained." Well, drum roll, Federal Reserve Chairman Ben Bernanke in congressional testimony on Capitol Hill. What about, another gem by Ben Bernanke. February 14th, 2008. Bernanke said, "At present, my baseline outlook involves a period of sluggish growth, followed by a somewhat stronger pace of growth starting later this year." That was in 2008. What happened later that year? Well, the whole system almost collapsed. Well done, Mr. Bernanke. So that was in congressional testimony on Capitol Hill. What about May 7th, 2008? Another gem from the people who saved the world, right? Bernanke and now Hank Paulson, Treasury Secretary, ex-Goldman Sachs. He said, "I do believe that the worst is likely to be behind us." Treasury Secretary Henry Paulson in a Wall Street Journal interview. I guess that was a few months after Bear Stearns had to be bailed out by JP Morgan or taken over. So there you go. That's why when I listen to people like that, policy makers and powers that be, I take it with a huge pinch of salt. So what about the markets? So right now it's 7:58 a.m. London time. Gold is at 1325, down 2.5. Range has been 1324.50 to 1330 overnight. Silver is down 2 cents, 1467. Range has been 1466 to 1475. So precious metals for some reason came off quite a bit yesterday. Yeah, I know they had rallied, for 8 straight days prior to yesterday, so maybe a correction was due. Bit of manipulation as well, who knows. Dow is up 62, 26,121, up 0.25%. S&P is up 8, up 0.25 as well at 2893.60. Nasdaq 100 is up 0.4%, 75.33. Yeah, yesterday the markets did finish higher, but they finished well off the highs, overnight highs that we saw. The Dow finished up 78, the S&P 13. The Nasdaq did finish up 1%. So let's have a quick look at the chart of the S&P 500. You can see here in the drawing, I was looking at the head and shoulder that we'd broken the neckline. I said there was a target at 2650. I guess we got halfway to there. And since then, the things have changed. I guess the Bullard and the Powell put came out last week, so that didn't help. You can see we're still not looking great. I think we're still forming a top that started being formed back in the end of January 2018. We could be forming another shoulder here of a, you never know with technical analysis. We could be forming an even bigger shoulder. It looks like we could be turning back down. Who knows? The rest of the markets, currency market, we've got cable or the pound down about 7 pips, so virtually unchanged, 126.76. The euro fairly firm, still above 113, up only 6 pips, 113.18. Dollar yen up 0.12%, so the dollar's firm against the yen, 108.57, and the dollar's down 0.2% against the Chinese yuan at 693. Crude oil WTI is up 0.2%, 53.83, and Brent is up 13 or 0.2 at 62.12. Bond markets, let's see here, 10-year yield is at 2.14, unchanged. 3-month T-bill yield is at 2.29, so 15 basis points inversion of the yield curve still. So there you go. Yeah, the bankers are pushing for lower rates, and so are the markets, and the Fed will probably give it to them. So even though the bankers, the markets, central bankers are signaling lower interest rates now, cuts, maybe even QE, 0 rates, they know that it will create carnage, as Mr. Moynihan from Bank of America said. So yeah, don't listen to just one side of their mouth, but listen to the other one as well. If you enjoyed this video, make sure you hit the like button. Subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.